So this is actually our 10th annual presentation. When we started, who was here when we used to do it in the room across the hall from our office? Do you remember that? So that was 10 years ago, and we were a smaller firm at that time. We were managing about $300 million, and we had a staff of 8. And as Scott will tell you in a few minutes, we've gotten bigger. And some of the things that we do have had to change. But one thing that certainly hasn't changed is our appreciation for you, our clients. Many of you have been with us longer than 10 years. And over time, our ties have extended to 2 and 3 generations of many of the families in this room, and to your siblings and your friends and your acquaintances. We're so grateful that you've trusted us enough to recommend us to your family and friends. Another thing that hasn't changed is our desire to know each family as individuals and to tailor our investment program to meet each family's needs, one by one by one. That's why we insist on meeting our clients face-to-face at least once a year, even if you don't want to. And Sonia will hunt you down. Knowing on paper and knowing in person, 2 very different things. And we want to know you in person. Tonight you'll hear about the economy from me and about the sectors we think hold special promise for investors in 2017. Barry, my partner and Chief Investment Officer, will talk about how we do what we do and why we buy what we buy. As always, he'll have some great examples. And Scott, our other partner, our Chief Compliance Officer and Vice President, who's going to lead off in a minute, will tell you about the way the firm works to benefit all of our clients, and he'll also tell you about some important and significant changes that will take place in the next few months.
Good evening and welcome. Thank you for coming tonight, especially with rain again this year. I do hope you enjoy our presentation. It'll be about an hour long, and as David said, we'll get through it and then get on to the good stuff with the cocktails and the food. So my name's Scott Mazie. I'm a partner and portfolio manager at Baskin. I've been with David and Barry for over 10 years now. So as David mentioned, this is our 10th annual Outlook presentation. It started out rather small, but for many years, the presentation was exactly that. It was our outlook about the markets and what we thought the economy was going to look like for the coming year. Recently, we've been using this event as an opportunity to expand the agenda and to basically provide you with some greater insight as to what we're thinking internally, how we're managing your money, discussing our philosophy and our style, as well as updating you on changes and developments that are happening within our firm and the industry at large. The reason we've done this is we believe that an understanding of what we're doing and a transparency around how we're doing it is very important for our relationship with you. So as a client, you can expect from us that we will be providing that transparency in our reporting, in our investment philosophy, and how we manage our business. So for those of you that attended last year, you may remember that the theme for my part of the presentation was making wealth management personal. I'm going to expand on that, but today I'm also going to share with you some initiatives that we're working on that ensure we'll continue to meet the needs and expectations of our clients, both now and into the future. So in a world of one-size-fits-all products, we're working very hard to make wealth management personal. We don't think that off-the-shelf automated solutions or robo-advisors are able to provide our clients with the returns or the service that they deserve. So at Baskin Wealth, we take a very different approach. There are 3 pillars to our business: portfolio management, service, and team approach. Through effective portfolio management, we're building your wealth and protecting your capital. We do this by constructing a customized portfolio for each and every client that we have, with the asset allocation and security selection tailored to the particular needs of each family. The ongoing maintenance of these portfolios require active management, which we provide. In addition, as your needs change, your portfolios will change. The second pillar to our business is service. Simply put, our goal is to provide you with a superior client service experience. We recognize our responsibility to the families that we serve, and we take this very seriously. The third pillar is team approach. So we take a team approach to both the portfolio management and to the service side. So if I refer you to the bottom of page 2 of your handout, there's some examples here of what I mean. On the portfolio management side, you'll see all of our security selection decisions are made on a team basis by our investment committee. There's a consistent application of our philosophy across all the client portfolios. And we also are process-driven, which allows for consistency among the portfolio managers. On the service side, we allow for direct access to the decision makers or portfolio managers. And we promote a consistent culture within our firm. So how do we know if we're doing how do we know we're doing a good job at this? One way is the client feedback that we receive. Another way is by measuring our client retention. In the past 5 years, we have retained over 98% of our clients. This is measured by both number of clients and also assets under administration. Over the previous 2 years, that number gets even better. It's over 99% of our clients. Also, not only have our clients stayed with us, they've also entrusted us, in many cases, to provide more of their wealth to us to manage. And our clients have trusted us enough to recommend their family and friends to us. A significant amount of our growth comes from referrals and comes from new deposits from our existing client base. Of course, this is in addition to the strong returns that we have as well. So if you look at the graph on page 3, you'll notice that we've experienced tremendous growth over the last 12 years. Our assets under administration have grown by nearly 700% to over $934 million as at the end of August. And that includes our 2008 experience as well. When we look at this graph, we recognize the challenge that our growth presents. So how do we maintain or even improve upon our high service levels, our strong returns, and our style of close personal contact in this sort of growth environment? The answer is that we do it by investing in our business. It's interesting to note that we've heard this for some time with two Bank of Canada governors, that they're not impressed with the Canadian business community, feeling that they're not investing enough into their businesses. And the argument for that is that a lack of business or a lack of investment impedes productivity. That is why we're investing in our business, and we're investing in technology. We use technology to increase the efficiency in all areas of our business. Given that we're process-driven, technology allows us to better leverage our human resources. We're currently implementing a new portfolio management and client relationship management software. So this system will provide our portfolio managers with a better toolbox to manage and administer your portfolios. This will also improve all elements of our service delivery to you as well. We also look to enhance our electronic research capabilities. So because all of our research is done in-house, and that's what drives our portfolio management decisions, we're always looking to upgrade our tools in this space. Next, we're moving towards a paperless office, and we're looking to roll out an online client portal that you'll have access to. Clearly, these changes will improve significantly the communication that we have with you. Secondly, we're investing in our team. As you saw here, we have a large number of employees that are now with us. Technology has its purpose because it certainly allows us to increase our productivity, which is important. However, we believe that wealth management is a human business and it requires close personal contact. So as we have grown with our assets and our client base, we've continued to add to our staff and our employees. Over the last 5 years, we made several key additions, and our staff has increased a total of 75% to the 21 number that you saw here this evening. With these increases, we've added depth and we've added expertise in important areas. We've got a fourth portfolio manager, a trader, a research analyst, and a manager of operations. We've also invested in our compliance regime and team. As a regulatory environment has become increasingly onerous, difficult, complex, and has been significantly growing over the last 10 years. We aim to be at the forefront of our industry in this space to ensure the safety of your assets and to minimize the impact of the new regulations on you. Finally, I'm pleased to say that we're also expanding our space. So our office space will increase by over 50% starting next month. We'll be adding new meeting rooms and added or enhanced audio-visual capabilities. So we look forward to you seeing those and conducting our meetings with you in that new space. Let me conclude by saying we appreciate and we value your business. Therefore, we're investing in our business to make sure that you get the returns and the service that you deserve and that you've become accustomed to. Thank you.
So for people who have never been here for one of these, the economics lecture is about to commence. And we do it using this book. So what I'm going to do is I'm going to talk for a few minutes about what's going on in the economy, then I'm going to talk about some sectors that we like very much, and then I'm going to talk specifically about the economic and investment environment. So if you could turn to page 5 of your book. I feel like a little bit of a broken record because I think this is the third year in a row I've talked about how disappointing the economic recovery has been after the Great Recession. We've titled our talk tonight, Secular Stagnation, Living in a Low-Growth World. And when I say world, I don't just mean Canada or the United States or Europe. It's really the entire world that's in now a low-growth environment. And if you look at the very top chart, the green lines are the world economy, the red lines are the developed economies, the Organization for Cooperation and Economic Development. And what you can see is that coming out of the recession, which is the downward line below the chart, growth has been consistently below 2% in the developed world. Now, everybody used to think that normal growth for the developed world was more like 3 or 3.5 or even 4%, and coming out of a very deep recession, perhaps 5 or 6%. We haven't experienced that. And what I really want to talk about tonight is why that's the case and why we think it's not likely to change very quickly. If you look at the chart at the bottom of this page, the blue bars, these are the forecasts for various parts of the world, and what you can see is that the forecast for the United States, unless Donald Trump gets elected, in which case growth will be 4%, he tells me, is actually now predicted to be less than 3%. The governor of the Bank of Canada the other day said that growth in Canada will be less than 2% in 2017. European growth just ticking along above 0. And even the dynamic economies of India, Southeast Asia, and China are struggling to grow at 5%. So it truly is a low-growth world. So let's talk about why that is. If you turn the page and look at the red graph at the top, This graph shows you the rate at which world population is growing. And if you look back to the left-hand side in the middle 70s, world population was growing at over 2% a year. And when I was studying economics back in those days, there were books like The Population Bomb, which talked about how everybody was going to be starving to death by now. And the Club of Rome was talking about the limits of growth, and we were going to run out of everything, including all metals and minerals. Well, it hasn't happened, and one of the reasons is population growth has been moderated by a few very important global trends. The trend to educate women worldwide leads to lower fertility. Urbanization, a huge trend worldwide, leads to smaller families simply because people who live on the land need to have sons to take care of them by farming when they're old. This is not the case when they're living in the cities. Easier access to birth control, China's one-child policy, these have all led to reduction in population growth around the world. And US fertility, the number of children born in the United States, was at the lowest level in history in 2015. As the world has fewer babies, there's a second phenomenon which is going on, which you can witness to some small extent in this world and in this room, in that people live longer. If you look at the graph at the bottom of the page, the steady line shows you the number of children in Canada under 15 years old. And the upward sloping blue line shows you the number of citizens over 65 years old. And you can see that those lines crossed for the first time last year. And the projection is that instead of having 2 children for every senior citizen, as we did when I was growing up, we're soon going to have 2 senior citizens for every child. This has profound effects on the economy for a number of reasons. Older people spend less money on things like household formation, buying cars, buying durable goods like refrigerators and stoves and carpets. And they also spend less money on durable goods, non-durable goods, as they get older. In short, an older economy is a less vibrant economy, one that has inherently lower growth. There's a third factor which is very important, and as one watches the election in the United States, this is one of the great elephants in the room that nobody talks about directly. But I really want you to look carefully at the graph at the top of page 7, because to me this is one of the most important things that's happened in the developing economies in the last 50 years. The red line at the top of the graph shows you the percentage of adults who are active in the labor force. And what you can see is that in the United States, that percentage was growing until 2000 and has since literally fallen like a rock from 65% of the population to about 58% of the population. That may not sound like a lot, but that's about 10 million people in the United States who are no longer actively looking for work. They're no longer productive. They're no longer adding to the economy. They're consuming, but they're not producing. More important, the share of the US economy that is paid in wages to working people has been in a steady decline since 1970. If you look at that spike in 1970, 52 cents of every dollar in the US economy went to wages in 1970. By this year, that's down to 42 cents. What does that mean? As people get less money in their pockets from wages, their ability to consume is obviously constrained. 70% of the US economy is based on consumer spending. Where's that money going if it's not going to wages? Corporate profits, as a percentage of the US economy, are at a record high. And one of the effects of the technological revolution and the automation revolution has been to divert money away from wages and to corporate profits. For better or for worse, That's what's happened. And when you look at the Donald Trump supporters in Middle America, in Ohio and Indiana and Missouri, who complain about the loss of factory jobs and so forth, they're absolutely correct. That has happened. And they're absolutely correct that they haven't had a raise in real wages, probably in many cases for 20 or 30 years. How to fix those trends, difficult question I'm not going to talk about tonight, but it's important to recognize the reality of what has happened and why that makes growth so much more difficult. So if we're in a low-growth world, what do we do as investors? Well, one of the things that we know is that people who have to live from their investment portfolio need a certain amount of yield. The graph on the top of page 8 shows you what's happened in U.S. stocks. The red line is real estate investment trusts. The blue line is utility stocks. The thick blue line at the bottom is the S&P 500. What you can see is that people have been bidding up the sectors that offer them yield. And why is that? It's because bonds pay almost nothing. Take a look at the graph at the top of page 9, and we're going to go back to this theme as we proceed. But this is the yield on the Canada 10-year bond and the German 10-year bond. And what you can see is those yields have been going down not only steadily, but also quickly. And as I'm sure pretty much everybody in this room knows, the yield on German bonds is in fact negative, less than zero. And the yield on the 10-year Canada bond is just north of 1%. 1% before taxes, before inflation. You can see why people are chasing yield. I want to talk briefly about why. How did we get to this case where bonds have negative yields, which doesn't make a lot of sense? Well, one of the reasons has to do with the program of quantitative easing that central banks pursued all over the world, chiefly starting in the United States, but also now in Europe. What is quantitative easing? Look at the graph on the bottom of page 9. Quantitative easing means the central bank was buying bonds in the market, basically replacing bonds with cash. In the case of the Federal Reserve Bank of the United States, they bought $3.6 billion worth of bonds, trillion dollars worth of bonds. A trillion is 1,000 billion. $3.6 trillion worth of bonds, and replaced those bonds with cash in the market. So the idea was people will have $3.6 trillion of cash to spend, and interest rates would go lower. Why? The Federal Reserve was buying up every bond in sight. When demand goes up, what happens to prices? They rise. When bond prices rise, interest rates go down. Quantitative easing was a spectacular success in driving down interest rates worldwide. It wasn't such a success in getting people to spend that money, because a lot of that money is sitting idle in bank accounts, garnering almost zero. It did not stimulate the economy to the extent hoped. So that's the situation. It's a low-growth world, so what do we do about it? Well, just because the world is growing slowly and the North American and developed world economies are growing slowly, it doesn't mean that every sector of the economy is necessarily growing slowly. There's always bright spots, and one of our jobs, and the jobs that we use our research capability and set our analysts to examining, is where do we find above average growth in a low growth world. So I'm going to talk about 3 areas that we think offer some promise, not only in 2017, but also going forward. And the first one has to do with what we call experiential consumerism. Experiential consumerism simply means that people, instead of buying stuff, buy experiences. When you go on a cruise, when you go to a Blue Jays playoff game, not anymore this year, when you go to a concert, when you go to a spa, you're buying an experience. That money could have been spent on buying stuff, a computer, a book, clothes. Millennials, the generation born between 1980 and 2000, turn out to be very big consumers of experiences. And the millennials are now the largest generation in North America, having supplanted my generation, the baby boomers. And that's what the chart at the top of page 10 shows you. The blue lines are the millennials. They now dominate the economy. And they're different than the baby boomers in a number of ways. In the first case, many of them live at home for much longer than their parents. The graph at the bottom shows you the number of 18 to 34-year-olds living with their parents. And what you can see is that number has skyrocketed. The cost of housing, extended periods of education, the trend towards later or no marriage at all has led to people living in their parents' house. And what's the impact of that? When they're living in their parents' house, they don't form their own household. They don't need to go out and buy their own fridge and stove and carpets and drapes. They don't buy those hard goods upon which much of the economy depends. Look at the graph at the top of page 11. The median age at first marriage in the United States. Doesn't look like much of a change from 22 to 29 for men and from 19 to 26 for women, but that 7-year difference is huge. It's huge in the same way in that it makes for later household formation. And finally, the mother's age at first birth, you can see that that's also steadily been going upward. Having babies is expensive. I was listening to the CBC radio this morning with people talking about the expense of daycare. Babies cost money for daycare, for diapers, for clothing, for everything. Again, millennials are having their babies later and they're not spending that money at the same time that we, the baby boomers, did. These are drains on the economy, but the bright side is, instead of spending money on that stuff, millennials are spending money on, turn the page to page 12, experiences, cars, personal goods. I can tell you that in my generation, it would be unheard of for one of my friends to pop over to Paris for the weekend. It would be unbelievable for somebody to spend $1,000 or $2,000 for tickets to a Raptors game or a concert at the Air Canada Centre. But this is a commonplace among the millennial generation. It's changing the way money is being spent. And if you look at that blue line, the forecast is, in the next 5 years, experiential consumerism is going to skyrocket. So we have to find ways to invest in that sector. How do we do that? Well, we're looking at things like cruise lines. A lot of people owned ski resorts. We're looking at Cineplex, movie theaters. You know, it used to be when you went to the movies, it was a $20 deal. Now you can book your VIP seat online. You can sit down in a fancy seat, have a glass of wine and a roast beef sandwich bought to you, and you can spend $100 to go to the movies. That's experiential consumerism. We want to find ways to invest in that sector because that's where the growth is going to be. That's number one. Number two, the graph on the top of page 13 is in many ways the most amazing and interesting graph in the book. This is a graph of the cumulative number of downloads from the Apple Store in billions. Think for a minute about what 130 billion downloads from the Apple Store means. There's around 5 billion human beings on Earth. That means on average, every human being on Earth has downloaded 26 times from the Apple Store. Ladies and gentlemen, there is no company in the history of the planet that has had a more intimate relationship with so many people at the same time as Apple does with the people who are downloading now 82 million downloads per day, 3.5 million downloads per hour, 2.5 billion per month. How can we not be involved in this sector? Take a look at the graph at the bottom. I have to tell you that 5 years ago, I had never heard about the cloud. I had never heard about storing things in the cloud. The cloud has grown by 1,000% in revenue in the past 7 years, and is projected to continue growing at a high rate. One of the most interesting things about the technology sector is that it's become a winner-take-all world. In every sector of technology, one company comes to dominate and take the lion's share of revenue. The graph at the top of page 14 shows you that in spite of all the companies that try and get you to use their search engine, Google still dominates search, 70% of all search. The graph at the bottom, in spite of all the social media you hear about, from Snapchat to Pinterest to Instagram, Facebook still dominates social media in a huge way. The graph at the bottom of page 15, which is hard to read, shows you the share of operating systems that Microsoft controls. In spite of everything you've heard about Android and Apple, Microsoft absolutely has captured the world of operating software. So what does this mean for us? It means that we have to be involved with big technology companies. Clearly, the growth in this space has not stopped, and it's not going to stop, but it also means to us that there's very little point in trying to pick winners in startup technology. I know how tempting it is to try and find the next Google or the next Facebook. The odds of being successful, unfortunately, are very low. Because of the way the technology has evolved in this winner-take-all paradigm, trying to find somebody who's going to supplant those companies or gain a major share, very difficult. We're not going to play that game. As you know, we like big companies with a history of profits. That's where we think we do our best. Third sector, healthcare. I'm sorry to say that so many of our clients are having a direct experience with the healthcare industry. So many of our clients are experiencing the inevitable difficulties that arise from aging. And if you look at the chart at the top of page 16, which shows you life expectancy in Canada, as life expectancy has increased, our expenditures on medical care have increased and will continue to increase. Just for one example, if you look at the chart at the bottom of page 16, these are tests and procedures to manage diabetes, which is an epidemic disease all over North America and in much of the world, in fact. Look at the growth between 2000, the short bar at the bottom of the graph, to 2030, when the baby boomers will be in their 70s and 80s. You can see that it's growing by a factor of more than 400%. We need to be in that kind of space. Look at the graph on the top of page 17. This is the cost of specialty pharmaceutical products, which is rising by 22% per year, compounded every year. We need to be in that space. Finally, look at the graph on the bottom of page 17. This is bad news, by the way. This is the number of hip fractures per year among baby boomers. As you can see, we'll be up 500% between 2010 and 2030. One of the companies that we own makes artificial hips and knees and spinal stabilization products, and also implantable teeth, of which I have two. Another sector that we have to be in. So the message, ladies and gentlemen, is in a stagnant economy, while demographics is our enemy on the overall front, it can be our friend if it points us to specific sectors. So those three sectors, experiential consumerism, healthcare, and big technology, are actually benefiting from demographic trends, and we think we can make money even in a low-growth world by investing in those sectors. I'm now going to go on to the third part of my talk, which is our actual expectation for asset classes in 2017. So if you turn to page 18, I'm going to talk briefly for the last time about bonds. When I started in this business, the rule of thumb was that we as asset managers should allocate bonds to our clients in a percentage equal to their age. In other words, if the client was 60% of their portfolio should be in bonds. If they were 80% of their portfolio would be in bonds, and so forth. Well, that was then, and we can't do that now. Why can't we do that now? Well, for obvious reasons. Look at the graph of the yield in gold of the 10-year bond, 1%, and the 2-year bond, which is around 0.4%. Again, before taxes, before inflation. Buying bonds cannot make you rich in the present environment, and the chairman of the Bank of Canada said that interest rates in Canada will not rise in 2016 or 2017, and maybe in 2018. If we bought 70% bonds for 70-year-old clients, they could not live on the income from their portfolios, and they should fire us. So we don't do that. We can't do that. Paradigms have changed. We buy bonds now solely as portfolio stabilizers to dampen volatility when the markets are shaky, to provide some base interest income, particularly in registered accounts where the interest does not get taxed. But bonds are not a winner in the current environment, particularly government bonds. Corporate bonds, somewhat better. We can buy corporate bonds that yield something like 2.7, 2.8%, not great, but better than 1%, or better than half of 1%. And we do that for our clients. All the bonds in our portfolios are corporate bonds rather than government bonds. An area that we were burned on in the last few years was preferred shares. I know many of you sitting here get a bad feeling in your stomach as soon as I say the word preferred, because we had a bad experience. The preferred share world has changed. There's new classes of shares that offer us real opportunities to get yield and stability, and we're buying those for our clients. So our expectations are bonds will be a poor asset class, corporate will be better than government, preferred shares will be better than bonds, particularly for taxable accounts. What do we think about currencies? Well, the Canadian dollar had a crazy ride the last 12 months. I don't know how many of you remember that last December the Canadian dollar got down to about 68 cents, and that 3 months later it was tickling 80 cents. Now that's not supposed to happen. You're not supposed to get a 20% move in what we think of as a major currency. But it happened anyway. And the Canadian dollar is now down today, I think, just under 76 cents. Our expectation for 2017 is that the Canadian dollar will likely drift lower, unless it falls lower. What could cause it to fall lower? If the Federal Reserve in the United States raises interest rates more than 2 times, 3 or 4 times, and the Bank of Canada doesn't raise interest rates at all, the yield differential on US dollar securities compared to Canadian securities will become so large that there will be, as Ross Perot once described it, a giant sucking sound of money swishing out of Canada into the United States. And as people sell the Canadian dollar to buy American dollars, it's certainly possible for us to see the Canadian dollar falling to 70 cents US. The only thing that could make the Canadian dollar go much higher, in our view, is some sort of crisis in the oil world, a wild card event, Saudi Arabia and Iran getting into a war, or something like that. Other than that, we think the Canadian dollar is due for a weak year. In regard to the euro, which was very stable against the US dollar in 2016, we think it'll continue to be stable. The events surrounding Brexit could have unpredictable results, particularly if other countries, such as Scotland and Ireland, decide they want to exit the European Union as well. That could have an effect on that currency. Canadian stocks, our core competence where most of your money is, had a good year this year. And I'm glad you got your report for the quarter ended September 30th, because we had a good quarter. The sectors that are doing very well that we like are dividend-paying stocks. And the reason is in this chart at the top of page 20. The gold-colored line is the dividend yield on the TSX, around 3%. Many of the stocks we buy are north of 3%. If you compare that with the blue line, which is again the yield on the bonds, what you'll see is dividends are now substantially more lucrative than bonds. This was not always the case. As recently as 15 years ago, bond yields were more than twice as high as dividend yields. Now it's quite the reverse. Dividend yields are 3 times as high as bond yields. So we have to own stocks that pay dividends, particularly since we don't see interest rates coming back anytime soon. And when people tell you that the stock market is expensive, when measured price-earnings ratios, price to book value, the big reason is this chart. People need yield. People will buy stocks and pay a bigger price for stocks that offer yield because of TINA. Who's TINA? TINA is there is no alternative. TINA says if I can't get yield from certificates of deposit, I can't get yields from bonds, I'm going to get yield from stocks, even if I have to pay a little more for them. So the kinds of stocks we're going to be buying in Canada, we're going to keep our core positions in banks, in utilities, in phone companies and pipelines that are offering yields around 4% and in some cases higher, and in real estate investment trusts, which also offer yields in some cases as high as 6%. We think those are good places to be. Maybe not high growers. Barry, how many Canadian banks hit record highs today? I think
everyone except National Bank that we own a lot of.
5 of the Canadian banks hit record highs today. You could say, Baskin, what are you doing buying banks at record highs? What's anybody doing buying those banks? The answer is, TINA, we need that yield, and we know those yields are going to continue to rise. Dividend growers offer stable income. We'll supplement those with our thematic stocks and special situations. Let me go on to U.S. stocks. Take a look at the graph at the top of page 21. The blue line is the S&P 500 index, the index of the 500 largest traded companies in the United States, and the gold line is the earnings of those companies. Now, normally you would think those lines would follow each other, right? You would think if earnings are going to go up, the S&P 500 should go up. If earnings go down, the S&P 500 should go down. But what you're seeing here is a divergence. Earnings on the S&P 500 haven't really gone up at all in 3 years. They've been very flat. But in that same time period, the S&P 500 went from 1,800 to 2,200. Why is that? Who wants to say the word? TINA! Exactly. It's because of TINA, and people who call for a market crash don't seem to share our understanding of this, which is not to say there can't be market corrections. There's always market corrections. But the fundamentals of the world economy support dividend-paying stocks. And if you look at the graph at the bottom of page 21, what you will see is that companies in the United States are spending more and more of their cash paying dividends. In 2010, 30 cents on every dollar earned by American corporations went to pay dividends. Today, it's up to 40 cents and rising. Companies recognize shareholders want dividends. So, what do we see for U.S. stocks? We're going to be buyers of U.S. stocks when the Canadian dollar is below 75 cents. We're going to buy in our thematic areas. As you know, Canadian shareholders of U.S. stocks have a number of disadvantages. We don't get the dividend tax credit on U.S. stocks. When we pass away, we can face difficulties with U.S. estate tax. Nonetheless, in our thematic areas, experiential consumerism, healthcare, and big technology, most of the main plays are American companies the advantages in our mind outweigh the disadvantages. So the areas of focus, as you can see on the top of page 22, are what we've talked about. High dividend growers, our themes, special situations. What are we not going to buy? Those of you who've been clients of ours for a number of years know the answer, but I'm going to tell our new friends, we're not going to buy precious metals. In fact, we own no metals at all right now. We're not going to buy fossil fuels and companies serving the fossil fuel industry. We like companies that are price makers. Everybody in a commodity business is a price taker. They can't control their own fate. We're not going to buy junior technology companies because we think it's a winner-take-all world where big tech dominates. And we're not going to buy junior biotech companies. We think the odds of somebody curing cancer in their basement are pretty small, and we would rather stay with the tested, profitable, dividend-paying companies. So that's our outlook for 2017. We think we can do okay. We think we have to be picky, as always, and mostly high-quality stocks, bonds as stabilizers, buying the U.S. companies when the Canadian dollar is weak, and that's what we're going to do. So I'm now going to hand it over to Barry for the third section of our presentation. Barry kind of is, as our Chief Investment Officer, the guardian of the secret sauce. The guy who knows how to find what works and when it works, and he's going to tell us about that.
We all go through life making one decision after another. Some decisions are easy, and some not so much. Easy decision. I won't invest my money until after the election, just in case. Hard decision. I will take advantage of the bargains that exist today. After all, commerce and the economy go on, regardless of who gets elected. Easy decision. That stock keeps on going down. I can't take it anymore. Sell it. Hard decision. We should buy more of it because we've done our research. The company's profitable, and probably all the bad news is reflected in that stock's price. Easy decision. Everybody says the market is overvalued. I'm concerned. Sell. Hard decision. Let's be patient. Let's stay the course because no one knows if the market is overvalued or undervalued. So I'm not saying that the easy decision is always the wrong one, but in our experience, making the hard decision of trusting our research, ignoring the noise, and most importantly, being patient is our competitive advantage. Last year, at our Outlook event, I talked about being patient, and I referenced two stocks. One resulted in big gains after 3 years of being patient, the other a work in progress. So I'm pleased to report that now both of these stocks are doing very well for you. Not every stock that I'm going to talk about tonight is going to be in your portfolio, although probably in many of your portfolios, given the wide range of goals and objectives and risk tolerances that our clients have. So with that, I want to turn to page 23 and take you back to last year, a stock we talked about, Molson Coors. And so Molson Coors was a stock that our clients owned for 3 years, and it did nothing until 2015 when the stock doubled. So if you look at the graph, we're pretty pleased because in 2016, the stock is now up a further 25%. So being patient has worked out. The second stock I reference on page 24 is the TMX Group. This was a stock that did not work out in 2015. In fact, the stock, after we bought it at about $54 a share, dropped to $45 a share by the time we had our Outlook event in 2015, and then dropped again to $33 by the end of 2015. Oy vey, right? The good news is the stock is now, I think today, $62 a share. So pretty happy about that. Patient pays off. Patient pays off again. So a lot of you probably ask, how do we find fabulous ideas like the TMX Group and Molson Coors? And it's pretty simple. We use a checklist. We never invest without looking at our checklist. So we're looking at companies that have a long history of profitability, have great management, wonderful balance sheets, smart capital allocation, they know how to invest the money, And most importantly, we want to buy these companies at good valuations. We don't want to pay too much. And so on page 24, you can see an example of the checklist. It's nearly impossible to find a company that gets a perfect score on our checklist, but we look anyways. And the way we find companies is by reading, screening, and cloning. We love digesting information, and all of us are stock nerds, and we love reading investment books, investment blogs, analyst reports, you name it, whatever we can get our hands on to get an informational edge. One example of a company we found just by reading the newspaper is a company called KAR Auction Services. Now, KAR, I don't want to be too morbid here, but KAR Auctions is one of the largest owners of salvage yards in North America. And they benefit big time from distracted drivers who are texting and driving. We also use software to screen and identify companies that appear to be great businesses. We use filters to find companies that trade at reasonable valuations and generate high returns on capital. Many of you own Dr. Pepper, and this is an example of a stock we found by screening. This was a company that we found in 2012, generating high returns on capital, a big dividend growth, and so far so good on that stock. You know, by screening, that stock just bubbled up out of nowhere. No one gets a joke? Okay. The final way we find stocks is by cloning. So there's nothing wrong with copying ideas in the investment world. And we look to find what other great investors are owning, and we try to reverse engineer and figure out why these great investors bought these stocks. And sometimes we find a great idea. Many of you own AIG Insurance, and that stock was found by mimicking a great investor who laid out a pretty compelling investment thesis on the stock. So even after we come up with ideas to buy, we still have to decide if the company's trading at a reasonable valuation, because for us that's the most important. We want to make sure we pay a good price for a company. So how do you value a company? You know, stocks are not like bonds. There's no certainty about how much money you're going to get at maturity. So we use a simple formula laid out by the world's first portfolio manager, and that's Aesop. So I think you guys know Aesop, right? Tortoise and hare guy. So his formula was a bird in the hand is worth two in the bush. And that's really all it is. When laying out your money today, we have to make sure that there'll be more money coming back in the future. We have to know how many birds there are in the bush, how soon we'll get them out, and of course, we have to make sure we're looking at the right bush. So I want to put it all together for you, and if you turn to page 26, I'm going to talk about the Priceline Group, a stock that we bought for many of you in 2015. You may know Priceline from its commercial starring the coolest Canadian ever, Captain Kirk William Shatner. And what you may not know about Priceline is that it operates the largest online travel agency in the world. It owns websites such as Booking.com, Priceline.com, Kayak, OpenTable, and a few successful websites in Asia. When we looked at Priceline, it got many checks on our checklist. Long runway of growth, long history of profitability, smart management. The only problem, when we looked at it, it wasn't trading at a wonderful valuation until last fall. Last fall, the stock dropped from about $1,500 a share to well under $1,300. And so we pounced on it. And the long story short, we believe that there were and are a lot more birds in that bush. And the experiential consumerism as the theme that we're looking for. Travel, spending money on fun times. And you can see from the chart, page 26, that we're doing okay on Priceline. I don't want to bore you with the financial details on page 27. If you want to call me tomorrow, I can walk you through how we valued the company. Another example of a company we started buying in 2015 was Berkshire Hathaway. You might know that company. It's run by a guy named schmo guy named Warren Buffett, right? Heard of him? Okay. Warren Buffett, Berkshire Hathaway, the stock fell in 2015 by 10%. And that's the best time to buy a stock, when either the market has a hissy fit or when a company misses its earnings and all of a sudden the shareholders punish the stock. And we acted on that stock, and so far so good on Berkshire Hathaway. So even harder than buying a stock is figuring out when to sell, right? Ideally, we'd love to hold a stock forever. If you sell, you have to pay transaction costs. You may have to pay tax on your capital gains. And of course, who knows if the new stock that you buy will do better in the future than the one you already own. So when we sell or trim a stock for your portfolio, we're only going to do it for the following 4 reasons. And it's not going to be because the stock goes down in price. If we sell a stock, it's going to be because we've made a mistake. It happens. It's rare, but we make mistakes. We'll sell a stock if a company, if we find another company that has more potential upside, or a theme like David was talking about, experiential consumerism, that we want to get exposure to. We'll sell or trim a stock if its valuation gets to a crazy, absurd level. If that happens, and we should be so lucky, we have to trim or even sell the stock. And finally, we'll sell a stock if it gets too big in your portfolio, or if it gets too big in the overall Baskin wealth portfolio. I think it's a prudent thing to do to trim your winners and increase your diversification and reduce your risk. And so with that, I want to thank all of you. We can't be long-term successful patient investors without having our patient clients. So I want to thank you all for being patient with our patients.